Hey guys, all content discussed in this channel is due diligence gathered with aim at better understanding the nature of the current market in anticipation of the greatest squeeze in financial history. Let's dive in. Further losses were continued today in stocks. The market lost 11.93 points overall. Nasdaq saw an ugly decline of 1.3%. The Dow Jones did gain 0.4% and the S&P 500 closed 0.3% down. Nothing really came out today that. It's more of the market trying to rebalance and digest the possibility of new higher rates coming in over the next couple of months. Even though the news came out Wednesday, we are seeing the market for the first time take days of volatile trading as it tries to catch a good consolidation point. Indecisiveness is high right now. Everywhere you go, everyone has a different outlook on the economy, so markets are obviously running weird at the moment. The Fed minutes showed policymakers are considering raising interest rates and working on their balance sheet a lot faster than initially teased. St. Louis Fed President James Bullard said the central bank is behind on its mission to tame inflation. We know tightening like the Fed is planning could potentially lead to a recession, but that outcome would be a lot better than the one that will follow if the Fed does not get serious and start attacking inflation head-on. As for the Treasury yields, the 10-year notes rose to 2.71% while shorter-dated bond yields increased as well. The famous 2-year yield recorded its biggest 5-week gain, rising 2.52%. These years keep on rising more and more, and now economists are getting concerned that if they keep rising they could potentially cause monetary shocks. The war in Ukraine has no end in sight and certain commodity prices keep on growing non-stop. All in all, nothing really came out today of importance, but markets are definitely unrested. Once again, nothing major came from GameStop or AMC today. I wanted to talk about disappointment, as a lot of the comments I am seeing are frustrated investors ranting about the price and being overtly negative. I will say that most people here watched other YouTubers and are pretty active on social media. Most of you saw other notable AMC and GME investors say we were bound to leg up this week when there was absolutely no reason to believe that was the case, which I talked about in last Sunday's video. I got called a shill endlessly for being overtly negative, but in the end, I was a realist. Tell me, do you honestly believe someone can predict AMC and GameStop price movement by just looking for crossing averages? Do you think they will crack the Citadel algorithms by looking at the charts and comparing past performance and saying, since it happened then, it will happen again now? There is so much ignorance in the community because a lot of people hype what you want to believe and clickbait you for weeks into believing this is it. The truth is, nobody knows anything. In this movement, nobody works at Citadel or the banks or any other market maker. Nobody can predict when and how we'll gap up. We have evidence showing consistencies here and there, but that's it. All we can do is buy and hold. I also saw so many people taking out calls, gambling their money on that last run, and all those people are now real upset that all their money was taken from them and giving right to the pockets of the people shorting the stocks. I do agree options are used to play the price, but gambling the way so many people were doing so was only going to end up in losses. I had people mad at me because I was not showing compassion over them throwing their literally retirements and savings at options. People are not consistent with their beliefs and it leads to a lot of disappointment. If you are gambling to this degree, I can promise you that you will most likely pull out and lose everything, if you haven't already done so. Let me pull a Nostradamus here and tell you what will happen next. Next week, YouTubers and other pumpers are going to make videos and posts about how AMC and GameStop are consolidating and that they just have to bounce back strong and reach previously supported prices. They will use cherry-picked data of previous performance with no explanation as to why that performance in particular has to be repeated again. They will tout the algorithm and this and that and then AMC and GameStop and not going to move that way. When we buy GameStop or AMC, you have to throw money into and forget about the price action outside of the interest of buying more for cheaper. Stop getting swayed by all the clowns telling you they are smarter than all the thousands of people with PhDs building algorithms in Wall Street because they are not. Asterisk. The only thing we know is how this ends, not which turns the journey will take us. I might be a shill for telling you the ugly truth, but tell me then why I was not wrong about this dip when everyone and their grandmother were screaming leg up just 5 days ago. We have to stay focused. Many of you guys get too hyped on those spontaneous runs and think this can only go up endlessly. You already know what to do. Stay full Zen mode, add slowly and at a pace as the price comes down and go about your day. When we launch, you will know it, no reason to freak out over this. Also, quickly before we talk about performance, let me say that today we had some pretty big runners on Discord alerts. After the very first alert issued for entry, the stock ran over 40%, generating vast wealth for all in it. Come join us for a lot of exciting content, link will be in the description and comments. Let's talk about performance. The Fed submitted over $1.750 trillion in reverse repo operations today. Dark pool trades for AMC accounted for 53% of the total volume today, while dark pool trades for GameStop accounted 52% of the total volume today. AMC had a larger amount of buy orders than sell orders, with GameStop also having a larger amount of buy orders than sell orders. AMC had a very bearish day, losing over 7%. It began trading fairly weakly in the pre-market, and once markets opened, it began to quickly sell off again, going from 19.60 to 18.40. After this dip, AMC began bouncing back up before selling off started again, driving the stock downwards for the rest of the day and closing at 18.24, below the VWAP. As for what to expect next week, I will make a video about it. GameStop had a bearish performance, losing over 2%. It opened to a drop from 151 to 142. After this drop, GME began bouncing up, experiencing difficulty breaking above 150. Near the end of the day, it began weakening and selling off, closing at 146.19, below the VWAP. As for what to expect next week, like I said, I will make a video about it. On this next part of the video, I am simply going to copy and paste this morning's video segment for those interested in listening to it. If you want to skip that segment, I want to thank you for tuning in today for this short afternoon recap. Be sure to join the Discord for a lot more content too. I wish you an amazing rest of your day and to the moon. Hey guys, all content discussed in this channel is due diligence gathered with aim at better understanding the nature of the current market in anticipation of the greatest squeeze in financial history. Let's dive right in. Yesterday's morning video touched on some very important and complex topics in regards to our economy and how Wall Street's growth to power has unbalanced the economy. While making that video, for some reason, I kept thinking about the Great Depression and some of the similarities between what led to that economic catastrophe and our current circumstances. I decided to make a shorter than usual morning video quickly going over the most important factors that contributed to the Great Depression. The stock market crash of 1929 was a big shocker to everyone in the world, and even more so to people who worked in the banking industry or traded commodities on Wall Street. All of a sudden, the strategies that once yielded positive results would only lead to losses, creating a havoc and confusion, stalling the ability for America to bounce back quicker and resulting in worsening conditions for everyone. But what led to this? Well, the biggest reason lies in the Roaring Twenties. In the 1920s, the United States enjoyed great prosperity, similar to the 1990s period. It was a decade where money was flowing in the system, where significant changes were made that improved the lifestyles of every American and where there were little worries about potential wars in the world. However, at the end of this decade, there was a sudden economic slowdown, causing a recession in the latter half of 1929. One of the biggest factors that led to this economic slowdown was the Fed. They worried about an excess of speculation, so they began tightening at the beginning of September. This is very similar, albeit for different circumstances, to what is happening now. The thing is, back then, the economy experienced recessions every 2 to 3 years, so it was fairly common, and that led to people underestimating that one in particular. Other major causes for the depression were an overconfidence and oversupply. Businesses were overproducing but selling their goods at a loss, which went unnoticed by most investors. Investors were buying on margin at exceedingly dangerous levels. Borrowing money from stockbrokers was very common, and this overconfidence led to surpluses in industries. These things combined with the Fed beginning to raise interest rates, like they are doing right now in 2022, led to a worsening situation. One thing that goes unnoticed were the bad moves made by the government as well. Congress passed the Tariff Act of 1930, better known as the Smoot-Hawley Bill. Essentially, this was a bill that imposed high tariffs on other countries. As a result, other countries retaliated with their own tariffs on U.S. goods, which led to our imports falling 40%. This was the final nail in the coffin that sealed the stamp on sending us on a downward spiral for much of the 1930s. People tend to think about the Great Depression as a result of a stock market crash where the United States was unable to bounce back from. Though there was indeed a crash that took place in October and early November of 1929, there is actually no supporting evidence that backs this up, making it a wrong assumption. The stock market actually had a very strong recovery after the crash. The biggest villains in the story are the banks, to the surprise of no one. You see, banks had begun extending a lot of bad loans, which meant that banks were speculating too much. When the banks began to fail in 1930, that led to a domino effect where more and more banks began flipping over. Because we did not have deposit insurances back then, people lost all their money. Banks fails when their asset valuation falls below their liabilities and people don't repay their loans. The Fed can lend money and stop a run on the bank, but if banks are insolvent, there is really nothing they can do but just watch everything collapse on itself. The Fed now intervenes in the markets and adds a lot of liquidity to support the stock markets. There were deep fundamental problems in the economy that were overlooked, and when everyone expected a bounce back, since recessions were so common back then, it led to an overconfidence and little change, which further added to the inability of the economy to make a comeback. Banks' poor strategies and plans worsened and screwed over all their customers. The government's poor oversight is also culpable in all of this, and the Tariff Act constrained the economy into a chokehold that resulted in a depression that lasted for nearly a decade. Economists all argue as to what the biggest lessons should be so that we don't go down the same path again. Some of the most notable ones are that the financial sector should never be left to their own devices. Poor regulation always triggers stock market crash and poor economic fundamentals as Wall Street is hyper-focused on short-term gains. The financial sector is vital to the United States, and because of that, the strongest and most compelling argument is that it needs to be closely monitored and regulated. That is not happening at the moment, which is why the economy is beginning to show weakness and is unable to stop sliding down. Another big important lesson is that all-in-one type of investing does not work long-term. Like I said earlier, banks began lending money like crazy, and investors began putting all their money in single baskets. They believed they would get high return on investments from mortgage-backed securities and other risky assets, and they were all so very wrong. Government also needs to be ready to assist small businesses. The last recession made it clear that by paying attention to big businesses, especially banks, you forget about all the millions of people who are employed by smaller businesses. The government needs to do much better in balancing the stimulus they give out. In this recent pandemic, the government gave away trillions of dollars to huge companies that simply used the money to pump their stock. That money could have saved thousands of small businesses from bankruptcy if it was handed out more fairly. Back in the Depression-era days, the balance was even worse, which is why the economy had such a hard time finding a bottom and just kept falling. It was like every major point was met with the worst decision that could be made at that particular moment. As you can see, there are a lot of commonalities between what happened then and what is happening now. Of course, things are very different and not all similarities should be used as cautionary alarms, but some of the fundamental problems still exists and need to be addressed. The Great Depression marked a turning point in America where significant changes were made, but as we discussed yesterday, Wall Street has been working hard since then to undo all the restrictions and oversights and regulations imposed on them. They have monopolized power to a point that has never been seen before, and that will only lead to another economic tragedy, which is why it is so important to be aware of all these things. This was a shorter video than usual, but I hope you liked it. Let me know what you think in the comments below, and that is all I have for you guys. Thank you for making it to the end of the video if you are still here. Be sure to come on over and join the Discord for an even more engaging experience with fellow investors. We have tons of things there, from conversations about GameStop and AMC to day trading alerts, so give it a try. Links will be down in the video description. Thank you again for being a part of this channel. I will continue striving for better content. Enjoy the rest of your day, keep on buying the dip and to the moon.